Here's a game I want to play. Name a company with $500 million in annual free cash flow, a monopoly-like market position, 19 consecutive years of uninterrupted dividends, and a CEO who doesn't do earnings calls or give guidance. Got it? Most people haven't heard of it. Ticker is NEU, NewMarket Corporation.
And the reason we're talking about it today is that Q1 2026 earnings hit the tape this morning, and the company did something interesting. Revenue was slightly below last year, EPS was slightly below last year, and the company repurchased $125 million of its own stock in a single quarter, nearly double what they did a year ago.
The deliberate volume reduction plus the buyback acceleration is the whole story here. I'm Hudson Thomas.
And I'm Lana Chen. Let's get into NewMarket Corporation.
NewMarket Corporation is headquartered in Richmond, Virginia, and it's one of those businesses that sounds obscure until you realize how essential it is. The company operates two segments. Petroleum additives is by far the larger one, running through subsidiaries called Afton Chemical Corporation and Ethyl Corporation. The specialty materials segment is the newer growth piece, run through American Pacific Corporation and a company called Calca Solutions that NewMarket acquired in late 2025.
Petroleum additives is about 91% of revenue. Here's what they actually make: lubricant additive packages and fuel additive packages. When an oil company blends a motor oil, a gear oil, or a hydraulic fluid, they mix base oil with an additive package that provides all the performance characteristics: the viscosity control, the anti-wear protection, the oxidation resistance, the friction modifiers. Afton Chemical makes those additive packages.
It sounds like a commodity business. It is not. And that's the key insight about NewMarket.
Correct. Here's why. The petroleum additives market globally is dominated by four companies: Lubrizol, which is owned by Berkshire Hathaway; Infineum, which is an ExxonMobil and Shell joint venture; Chevron Oronite; and Afton Chemical. Those four players collectively control the vast majority of the global market. New entrants face extraordinary barriers: decades of engine testing data, deep OEM co-development relationships, global blending infrastructure, and an approval process where getting a new additive supplier certified can take years.
The OEM relationship piece is particularly important. When Ford or Toyota writes an engine lubrication specification, they do it in partnership with an additive supplier. That specification references specific chemistry. The lubricant maker then has to use additive chemistry that meets that specification, which in practice means buying from the supplier who co-developed it.
The business economics follow from that structure. Additive packages represent a small fraction of the finished lubricant cost, typically 2 to 4%, but they're responsible for nearly all of the performance characteristics. The oil company cannot skimp on the additive without risking warranty claims and OEM certification revocation. So Afton Chemical is selling a low-cost, mission-critical input with enormous customer stickiness and legitimate pricing power.
The specialty materials segment, 9% of revenue, is the growth story in progress. American Pacific Corporation makes specialty chemicals and energetic materials for aerospace and defense customers. The Calca Solutions acquisition in October 2025 added more specialty chemical production capacity and supply chain diversification. Management expects new production capacity from this segment to come online by the end of 2026.
So the summary picture is a dominant oligopolist in a niche that never goes away, with a growing specialty materials business that management is actively building out. Now there is one genuine long-term question hanging over this. Electric vehicles don't need engine oil in the same way internal combustion engines do. The less complex the drivetrain, the simpler the additive chemistry. That is a real long-term structural risk, and we'll address it in the bull and bear cases.
Tom Gottwald has run NewMarket as chairman, president, and CEO since March 2004. That's 21 years running the same business. He was previously CEO of Ethyl Corporation, one of NewMarket's core subsidiaries, before taking the top role. The Gottwald family are long-term controlling shareholders. Tom himself owns about 4% of the company, which is worth roughly $240 million at current prices.
And the management style at NewMarket is genuinely unusual for a public company. There are no quarterly earnings calls with analyst Q&A, no numerical forward guidance, no investor conference appearances. The company releases earnings numbers and a short press release, and that's it. Gottwald runs this company for long-term owners, not for quarterly expectations management.
Which makes the Q1 2026 buyback number even more interesting. When a CEO who doesn't talk to Wall Street deploys $125 million of corporate cash to buy back stock in one quarter, nearly 2% of the market cap in 90 days, that's a statement. He's saying, this stock is undervalued, and we are the most aggressive buyers at current prices.
The CEO's 4% ownership stake means his personal wealth is directly tied to the stock's long-term performance. That alignment is structural. When the company buys back stock, he participates in the upside on his personal shares. When dividends are raised, and NewMarket has raised dividends 7 consecutive years, never cutting in 19, his personal income increases. The incentive structure is as clean as it gets in public markets.
All right, Lana, the numbers on NewMarket. For a company this obscure, the financials are remarkably compelling.
Let's start with valuation. Trailing price to earnings is 14.1 times on TTM EPS of $47.28. Forward PE of about 13.5 times on 2026 consensus estimates. Price to sales is 2.2 times. Price to book is 4.37 times, which looks elevated until you understand that aggressive share buybacks have reduced book equity, the same dynamic that makes highly capital-efficient companies look expensive on book value. EV to EBITDA is 9.2 times. Beta is 0.52, which means the stock moves roughly half as much as the broader market.
Revenue for Q1 2026 came in at $669.7 million, down about 4.4% from Q1 2025's $700.9 million. And this is where the deliberate volume story comes in. Management shed lower margin petroleum additive shipments. Volume was down roughly 7% year over year on the petroleum additives side. Revenue declined, but the intention was margin protection, not market share loss.
Let's walk through the Q1 income picture. Revenue of $670 million, cost of goods sold of $449 million, leaving gross profit of $221 million. That's a gross margin of 33%, genuinely strong for a chemicals business. After operating expenses of $78 million, operating income reached $143 million, a 21.4% operating margin. Net income was $118 million, a net margin of 17.6%. These are high-quality earnings from a disciplined cost structure.
What about cash flow?
Very strong. Trailing 12-month operating cash flow was $569 million. Free cash flow after capital expenditure was $491 million. That is a business generating nearly $500 million of free cash flow annually on $5.9 billion of market cap, a free cash flow yield of roughly 8%. The machine is running well.
Balance sheet.
Manageable. Total assets are $3.49 billion. Total equity is $1.73 billion. Cash on hand is about $65 million. Total debt approximately $931 million, so net debt of $867 million. Net debt to EBITDA is 1.2 times. That's a comfortable leverage level for a business with predictable FCF. Current ratio is 2.53 times. Interest coverage is 13.7 times. No stress on the balance sheet.
And the dividend and capital return picture?
NewMarket pays $3 per share per quarter, $12 per year, which at the current stock price translates to a dividend yield of about 1.9%. The 5-year dividend CAGR is 6.6%. They've raised dividends 7 consecutive years without a cut in 19. Beyond the dividend, the company repurchased $203 million of stock in the trailing 12 months, including $125.6 million in Q1 2026 alone. Total capital return to shareholders between dividends and buybacks is running above $200 million annually. Overall, NewMarket's financial health is solid. Excellent cash generation, manageable leverage, and a disciplined capital return program that consistently rewards long-term holders.
What does the street say about NewMarket after today's Q1 report?
The street is barely covering it. There are effectively 2 to 3 analysts following the stock, which is extraordinarily thin for a $5.9 billion market cap company. The consensus is hold. 1 buy, 2 holds, no sells. The average price target is around $483, which is 25% below where the stock is trading today. That's an unusual situation where the market has moved well beyond analyst expectations.
The stock is trading above every analyst's price target.
Essentially, yes. The high end of the range is around $550, and the stock is at $643. The analyst community hasn't caught up with what the buyback math does to per-share intrinsic value. When a company with $491 million in annual FCF buys back roughly 3 to 4% of shares outstanding every year, EPS compounds mechanically even without revenue growth. The models haven't fully priced that.
What did the Q1 earnings look like against expectations?
Revenue of $669.7 million came in slightly below the street's rough estimate of $685 million, about a 2% miss. EPS of 12.62 was slightly below the 12.80 estimate. Both misses were small and largely explainable by the deliberate volume reduction strategy. Management provided no numerical guidance consistent with their long-standing policy. They did flag specialty materials capacity expansion expected in late 2026 and continued focus on margin discipline.
Let's build the bull case for NewMarket at $643 per share. The bull case starts with the buyback math. The company is repurchasing stock at a rate that suggests approximately 3 to 4% annual share count reduction. Against a FCF yield of roughly 8%, the total return to shareholders from FCF alone, before any multiple expansion, is substantial. This is the definition of capital allocation compounding. Buy a dominant franchise at 14 times earnings, retire shares aggressively, watch per-share intrinsic value grow faster than the business itself. Layer on the specialty materials catalyst. New production capacity at American Pacific Corporation and Calca Solutions is expected online by Q4 2026. This segment grew 8% year over year in Q1, even before the capacity expansion hits. It's a higher margin defense and aerospace adjacent business with government contract visibility, a very different demand profile than petroleum additives. And there's the EV reformulation opportunity that the bear case tends to overlook. Yes, electric vehicles use less lubricant than internal combustion engines, but EVs and hybrids require new thermal management fluids, new gear oil specifications for e-axles, and new battery coolant chemistry. Afton Chemical is actively co-developing these new additive packages with OEMs. The chemistry changes, but the need for specialized additives does not disappear.
Now, the bear case, which I think is worth taking seriously given the stock's valuation premium to analyst targets. The fundamental bear risk is petroleum additives volume decline beyond the strategic. The 7% shipment decline in Q1 2026 was partly deliberate, low-margin volume pruned by management, but it was also partly market softness. Global lubricant demand is tied to miles driven, industrial activity, and ICE vehicle sales. If the economy softens, if EVs accelerate market share gains faster than expected, or if lubricant customers destock further, the volume decline becomes structural rather than strategic. The EV displacement risk is real, and the timeline uncertainty is enormous. Afton Chemical generates most of its volume from internal combustion engine lubricants. In key markets like China, EV penetration is moving faster than most Western analysts predicted. If the inflection in ICE vehicle demand arrives in 2028 rather than 2035, the revenue base erodes faster than the buyback program can compensate. And there's the leverage question. Net debt of $867 million at 1.2 times EBITDA is manageable today, but management is buying back stock aggressively using debt capacity as well as free cash flow. If they maintain the Q1 pace through the year, net leverage could approach 1.5 times by December. Not alarming, but worth watching if petroleum additives volume softens simultaneously.
Let's put NewMarket's valuation in context. The challenge here is that the true direct competitors are all private. Lubrizol is a Berkshire Hathaway subsidiary, Infineum is an ExxonMobil and Shell joint venture, Chevron Oronite is a division. There's no clean public comp, so we're working with the closest available proxies.
Innospec, ticker IOSP, is the most direct public peer, a specialty fuels and performance chemicals company with meaningful fuel additives exposure. It trades at about 1.2 times sales and 16 times earnings on a $2.2 billion market cap. The lower PS relative to NewMarket reflects Innospec's more fragmented product mix and smaller scale, without the dominant lubricant additives franchise that gives Afton Chemical its pricing power.
Eastman Chemical, ticker EMN, is a $9 billion specialty chemicals platform with annual revenue roughly 3 times NewMarket's. It trades at about 1.0 times sales and 13 times earnings. The discount to NEU on a PS basis reflects Eastman's broader exposure to cyclical commodity chemicals alongside its specialty lines. You get more diversification, but less concentrated moat.
RPM International, ticker RPM, is a specialty coatings, sealants, and building materials company. At about 1.3 times sales and 20 times earnings on a $12.5 billion market cap, RPM's higher PE reflects faster growth in construction-adjacent markets. The comparison highlights an important point. Specialty chemicals niche businesses with strong recurring demand get premium multiples, and NewMarket's 14x trailing PE looks modest by that standard.
The peer table tells a consistent story. NewMarket is not expensive relative to specialty chemicals niche operators. The modest multiple reflects the petroleum additives volume headwind narrative that the market is pricing, not fundamental deterioration in the franchise. Options market on NEU, what's the picture?
Extremely thin. NewMarket's options market is one of the least active for any mid-cap stock, consistent with its 0.52 beta, limited institutional trading activity, and founder-controlled float. Implied volatility sits near the 25th percentile historically, very low, which means options premium is cheap, and the market views this as a sleepy, low-volatility compounder.
Is that complacency or accurate pricing?
Probably accurate. The business model is genuinely stable. Recurring additive demand from long-term OEM partnerships does not swing violently quarter to quarter. The $125 million corporate buyback provides a natural price floor. The absence of earnings call volatility, because there are no analyst Q&A sessions to create surprise moments, reduces the event risk that drives options activity. For most investors, there's simply nothing to hedge against in the short term.
Insider activity at NewMarket is a bit different from most companies because the ownership structure itself is the dominant signal.
Right? Tom Gottwald's 4% ownership stake, worth approximately $240 million, is the structural insider alignment. That is not a small stock grant. That's serious personal wealth tied directly to long-term share price performance. When the company pays a dividend, Gottwald gets paid. When the company compounds, he compounds.
But there were also fresh purchases. 2 Form 4 filings in February 2026 showed open market insider purchases in the $590 to $620 range, below the current price, which means those buys are now in the money. 0 insider sales in the last 6 months. And the corporate buyback of $125 million in Q1 is essentially the largest insider buy signal of all. The board authorized and executed a massive repurchase at prices it believes are below intrinsic value.
The combination of family-controlling ownership, fresh open market purchases, 0 insider sales, and accelerating corporate buybacks sends a consistent message. Management believes the stock is undervalued relative to the long-term earnings power of the petroleum additives franchise, even accounting for the EV transition risk.
Key risks to keep on the radar for NewMarket.
The primary risk is petroleum additives volume. Q1's 7% shipment decline was partly strategic. Management deliberately pruned low-margin business. But macro softness, ICE vehicle deceleration, or further customer destocking could deepen those declines beyond what management planned. If volume deteriorates faster than the specialty materials segment can compensate, revenue and earnings compress simultaneously.
The EV timeline risk is real, but slow-moving. The question is whether the market accelerates the ICE to EV transition in core geographies like China and Europe faster than Afton Chemical's reformulation pipeline can offset. This is a 5 to 10 year story, not a quarterly one, but it's worth modeling.
And the leverage watch is important. At $125 million of buybacks per quarter, net debt could approach 1.5 times EBITDA by year-end. That's still manageable, but it reduces the buffer the company has if petroleum additives revenue falls materially. The buyback pace is a benefit when the business is stable and a risk factor when you need liquidity headroom in a down cycle.
Bottom line on NewMarket Corporation.
This is a high-quality niche oligopolist at a modest multiple, using aggressive capital allocation to compound per-share value in the face of a real but slow-moving long-term headwind. The business generates $491 million in annual free cash flow, carries 1.2 times net debt to EBITDA, has never cut its dividend in 19 years, and is led by an owner-operator with $240 million of personal skin in the game.
The data point that matters most in the next few quarters is petroleum additive shipment volume trend. If volumes stabilize or recover in Q2 and Q3, signaling that the Q1 decline was genuinely strategic rather than demand-driven, the thesis is tracking. If volumes continue declining while the specialty materials expansion hasn't yet come online to compensate, the revenue story gets harder to tell.
At 14 times earnings and 9 times EBIT on a near $500 million FCF business, with a 21-year CEO who owns $240 million of stock and thinks in decades rather than quarters, the long-term risk-reward looks favorable if you share management's conviction on the petroleum additives franchise durability. The EV transition is the variable that the stock price will ultimately track over the next 10 years.
I want to close with something Tom Gottwald wrote in this morning's Q1 2026 earnings release, because it captures the management philosophy exactly.
Go ahead.
He wrote, "We will continue to invest in technology to serve our customers, focus on cost control and margin management, and advance our initiatives to build a global manufacturing network that will enable more efficient product delivery to our customers in the years ahead. We are also excited about expanding production in the specialty materials segment to provide more capacity and a stronger supply chain for our customers, and we expect to see that capacity come online towards the end of 2026. There's no mention of the stock price, no mention of guidance, no mention of next quarter, just long-term investment in the business and the manufacturing network. That's how you run a company for owners. That's going to do it for today's Charged Alpha deep dive on NewMarket Corporation. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.